Welcome to qnawire.
In the US tax system, what we have is that only realized capital gains are taxed, whereas accrued capital gains are not. So what this means is that the holder of an asset is not taxed on any increase in its value until they go to sell that asset. So the effect that this has on individual behavior directly affects that holder's willingness to sell the asset. Because if that holder doesn't want to pay the taxes on it, they just simply need to hold on to that asset. Now, it's not until they sell it that they'll be paying those taxes, meaning that they have this kind of leeway, this ability to avoid paying those taxes until their own specified date and time, right? They can choose if they want to pay those taxes today or if they want to pay them tomorrow or a year from now. It all depends upon when they actually want to sell that asset. Part B here, though, is asking us, how might cutting these capital gains tax rates raise revenue? Well, if all of a sudden it's less costly to sell, because if we think about these capital gains taxes that are paid when you go to sell as the cost of selling, suppose that instead that rate is lower. Well, because that cost of selling has gone down, it may encourage selling of these assets. And by doing that, we're going to see an increase in trade volumes, most likely, because all of a sudden people can sell their assets and buy new ones and sell those again within this specified period of time without paying as much in taxes. So even though we'll be taxing at a lower rate, that mass volume, that increase in this trade volume is going to make up for the fact that that rate has been lowered. So we're going to see this increase in trading volume, and that's going to be this ultimate reason why we could still see an increase in tax revenue even given these lower gains tax rates.